Oh boy. YouTube financial morons. The gift that just keeps on giving. Now, ladies and gentlemen, I am Christopher Bell, certified public accountant, long-term boglehead investor, and hater of garbage clowns on YouTube that try to convince you to buy garbage, worthless, trash stocks like Workhorse that will ultimately screw you over in the long run. Now, there's this guy named Stunk Mo. That's this idiot right here. You see him? Oh, look how much cash I have in my hand. I'm so rich, bro. This clown pumps the worst freaking stocks. Basically, I think his screening process to buy a stock is to find a stock that is massively diluting its shareholders by issuing new shares or convertible bonds or notes, and a stock that has growing losses, both on a accrual basis of accounting and a cash basis. Now, I'm really sick of all this crap. I'm really tired of all these garbage losers that are pumping worthless freaking stocks. And I'm going to show you in this video why Workhorse is a stinking pile of trash that is too highly speculative for you to invest in. Now, if you really want to invest in Workhorse, keep it to a small part of your portfolio. Maybe the stock will go up. I don't know. But you shouldn't have the majority of your portfolio in a worthless pile of trash like Workhorse, because you could potentially lose all of your freaking money. So let's go look at the financial statements of Workhorse, which I know none of you Wall Street bets clowns have done. All you've done is watch StockMo or whatever other clowns are pumping this stock. And that's all the information you need. He pulls up a newspaper article, or he shows his diamond hands, or he shows money in his hands like in this picture. And that's all you really care about. It's the future, bro. Now let's go look at Workhorse. Their financial statements, which are called 10Ks, which is a company's annual report that they file with the Securities and Exchange Commission. So this is Workhorse's financial statements as of December 31st, 2020. So when you're looking at these, the first thing you want to read, I mean, you can read a lot of stuff, but you can look at the risk factors of the company, which we'll do that real quick. Operational risks. You can look at the risk factors, you can look at management's discussion and analysis, and then you can look at the financial statements. The financial statements actually show you what's going on a fundamental level with the company. They are very important in your determination as to whether you want to invest in a company or not. And when I looked at Workhorse, I determined it was a stinking pile of garbage that is massively bleeding money and is most likely going to fail, okay? It may survive, but right now, I don't like it as an investment. I think it's freaking trash, and I'm going to show you why. And you can downvote this video. You're a hater. It's going to go to the moon, bro. I don't care. I invest based on fundamental analysis, which I know is boring to a lot of you clowns. So just looking at the risk factors right off the bat. Our results of operations have not resulted in profitability. We may not be able to achieve profitability going forward. Yes, they're not profitable right now. Oh, another note. We have yet to achieve positive cash flow. And given our projected funding needs, our ability to generate positive cash flow is uncertain. Looking good so far, isn't it, ladies and gentlemen? The development of our business, of course, a freaking jet flies over. The development of our business in the near future is contingent upon the manufacture and delivery of vehicles associated with orders from UPS, Pritchard Auto Company, and other key customers. And if we are unable to perform under these orders, our business may fail. Okay, whatever. So there's a ton of risk factors here, but you need to read these. Our limited operating history makes it difficult for us to evaluate our future business prospects and make decisions based on those estimates for our future performance. I don't know how you would do a discounted cash flow analysis of this company, of this stunk, if it's not even generating positive cash flows. But they may be signing some deals in the future, maybe. So, yeah. Blah, 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 blah. Blah, 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 blah. Blah, 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 blah. All right, so basically there's a lot of risk factors, but you should definitely read all those, okay? Instead of just going to Wall Street bets and reading those clowns. So the next thing we're going to look at is management's discussion and analysis. That's the management talking to you and basically explaining kind of what's going on with the company. Now, the 2020 highlights. We are a technology company focused on providing sustainable and cost-effective solutions to the commercial transportation sector. As an American manufacturer, we create all electric. See, it's all about EVs, baby. As long as it's an EV company, it doesn't matter what the financials are. Just put your money in it, bro, right? It's the future. All electric delivery trucks and drone systems, including the technology that optimizes the way these mechanisms operate. We are last mile delivery's first full purpose built mobility solution. Ooh, that's so exciting. So let's see some of the highlights. So they talk about COVID. Here's some interesting stuff. So it looks like they are buying some companies because on November 27, 2019, the company completed the sale, or they're selling it, of SureFly for $4 million. I don't know what SureFly is, but man, they sold it for $4 million. That means they're going to go to the moon, right? On October 31st, they entered into an asset purchase agreement to purchase certain assets and assume certain liabilities of Hackney. So I guess they're buying out this company, Hackney. All right? And then they also invested in LMC. The company entered into a transaction with LMC to grant LMC a perpetual and worldwide license to certain intellectual property relating to the company's W15 electric pickup truck. So it looks like they're buying some of this company as well. So, okay, they're buying some companies, which isn't necessarily a bad thing. But let's go ahead and look at their financial statements. Let's go look at the numbers, ladies and gentlemen. Not the hype, not the garbage, not the YouTube pumping propaganda, which is probably just a massive pump and dump scheme. Let's go look at the financial statements. Dun, 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 dun. This is boring. I want to see a twinkle in your eye while you talk about how this stock's going to 50,000 billion X. Oh my God, unsubscribe. All right, so let's go ahead and look at the financial statements. So we have the balance sheet, which shows you, it's a snapshot in a point in time. It shows you the company's assets, liabilities, and equity. So when you look at the balance sheet, you can look at the current ratio, which basically shows you how likely the company is to go out of business in the next year. Now, for the current ratio, you can look at total current assets, which they have $290 million. But I saw there's $194 million in restricted cash held in escrow. So that might not be able to be quickly accessed for the company. So really, we'd say the current ratio, if you subtract out the 194, is roughly $100 million. And then their current total liabilities, which is just basically short-term debts, is $17 million. So even then, I mean, the company's probably not going to go out of business within the next year. That's great. Now, another thing I noticed on this balance sheet, and you'll see it in the statement of cash flows and on the income statement, is that they have an investment in LMC, which I think is Lordstown Motors. In 2019, it had a balance of $12 million on their balance sheet. And then because of a fair value adjustment, basically the investment was worth a lot more, and they had to write that up on the balance sheet. That went up to $330 million in 2020. So they basically bought a company they got a company for a good deal as of now. Now, this is important because it's going to affect their income statement. It's going to show a massive, uptick in operating income. But it's really a paper gain because they just wrote up the value of an investment, which goes to the income statement and affects net income and retained earnings. But that wasn't actually a true gain because with accounting rules, you have to write up and write down trading securities based on adjustments to their fair value every year. So that's that. All right. They have an accumulated deficit. Now, an accumulated deficit is basically losses stacked up on each other. So if you have a loss in one year, let's say you have 50 million, and then you have a loss the next year of 50 million, your total accumulated deficit in retained earnings will be 100 million. So they just stack and stack and stack up on each other. Now, the accumulated deficit actually went down, which you may say, oh, it looks like they're, making a profit. They're doing better. They're getting rid of their accumulated deficit. Well, I suspect that that decrease is probably from that write-up of Lordstown Motors. So that's an important thing to look at. You want to see retained earnings increasing because that shows you the company's profitable, but you can get more details on the income statement. Another key thing, common stock. which is stock that the company issues to investors. You want to see that staying flat or even going down, because the more that common stock increases, the more the current shareholders are diluted, which means you get less and less earnings per share from the entire company. You don't want stock issued to go up. Now, looking at this, they had common stock with a par value of 0.001 cent of 67, million. Yeah, 67 million. And then it went up to 121 million in 2020. So they basically almost doubled the number of shares outstanding. So you almost got diluted by half if you bought some stocks in 2019. Now, it's good for the company because they're raising cash, but it's bad for the initial investors. And I wouldn't be surprised if they had to freaking raise more cash going into the future, because this company's bleeding. Lots of dinero, lots of cash. But it's going to go to the moon, bro. All right, let's go look at their consolidated statement of operations, also known as their income statement. Now, right off the bat, this looks like a complete stinking pile of garbage. Now, the first thing you want to look at is the net sales. Is their revenue growing? Yes, it is. That's a good thing. However, their cost of sales is higher than what they're selling their products for, the sales price. The cost of sales must be lower than the net sales in order to realize a gross profit from year to year. So basically, they're selling their crap at a lower price than the cost to the company to make the product, or whatever they freaking do. So their gross margin, Jesus Christ, this is freaking god awful. So in 2019 they sold, is this in millions, or is this just the actual numbers? I don't know. It doesn't even say millions. So their sales in 2019 might have just been 376,000. So you take the gross loss, which you take the sales price, all the revenues, minus the cost of sales to get the gross loss, which is freaking horrible, 5.4 million. Good God. But to find the gross margin percentage, you take the gross loss, which is 5468,329, divided by the sales. So they have a negative, what is that? 1,452% gross loss on their gross margin. That's freaking garbage. That is horrible. They're taking massive losses on the crap that they're selling. They need to raise their prices, in my humble opinion. Let's look at the next year. So their gross loss was negative 11,674,589 divided by their sales, 1,392,519. Wow. They actually improved their gross loss as a percentage of revenues. So in 2019, it was negative 1,400% loss. Now it's negative 838%. Wow, man. That is such a great gross margin right there. I am so impressed. All right, so that's just complete and utter stinking garbage. And then their operating expenses, they also increased significantly, mostly because of selling, general, and administrative expenses. That's a key thing you want to look at. Why did your selling, general, and administrative expenses go up by $10 million from 2019 to 2020? This is the kind of stuff you need to look at so you can read the notes to the financial statements. Now, the next key thing is other income. So in 2019, they had other income of $15,849,000. I don't know what that's from, but you see a massive increase in other income. So if you're just a noob and you're like, wow, look at how much the company's improved. I mean, the other income went up. Well, that other income is from the write-up in fair value for Lordstown Motors. That is the only reason they have such a massive spike in other income. So you can't project that number going forward unless they acquire another company, then that company explodes in fair value. But that's the reason that other income has increased. Now, they had a loss from operations in 2019 of $8 million, but they had a profit from operations in 2020. But that's only because of the fair value adjustment to Lordstown Motors. If it wasn't for that, they still would have had a massive freaking loss from an operating perspective in 2020. So don't get too excited. Now, the next thing, this is freaking scary. Look how much the interest expense has gone up. It's gone from 29 million to 190 million. That is a massive increase in interest expense. So they probably took out a lot of debt. Now, if we go back to the balance sheet real quick, let's see how much their debt's increased. Long-term liabilities. Here we go, right here. They went from zero in other long-term liabilities to 207,000. Deferred tax liability. Ooh, that's not good. That went up to 21 million. So basically they're taking a bunch of deductions up front, but they're going to have to repay those taxes later in the future. That's what a deferred tax liability is. And then convertible notes at fair value. So they issued a ton of debt. It went from 19,400,000 to 197 million. Holy crap. This company is going into massive debt just to survive, and they're massively diluting their shareholders. Woo! I'm scared to see the statement of cash flows here, ladies and gentlemen. I am so sold on this company. Man. Wall Street bets. You gotta love them. You gotta love them, ladies and gentlemen. So now let's look at the statement of cash flows. The statement of cash flows shows you the company's, cash going in and cash going out from a cash basis of accounting. The income statement is on the accrual basis of accounting. So in the accrual basis of accounting, revenue is recognized when it's earned, not when the cash is received, and expenses are recognized when they're incurred, not when the cash is paid. So you want to look at both. You want to look at the income statement that follows generally accepted accounting principles, and you want to look at the statement of cash flows because that shows you how much the money the business is making from a cash basis. Now, the first thing that you want to look at is net cash used in operating activities. So we'll zoom in just a tad. So you want this to be positive because that means they're generating positive cash flows from their operations. So in 2019, they had a net cash outflow of 36 million. And then in 2020, they had a net cash outflow of 70 million. So they basically doubled their losses on a cash basis from operations. Now, the beautiful thing about the statement of cash flows is that they actually subtract out the gain from the change in fair value of the investment in Lordstown Motors. So it's beautiful because if you look at the income statement, they're like, oh, they had a profit. Wow, that's so great. But if you look at the company from a cash basis, you actually subtract out that gain because it's a non-cash gain, which shows you the true loss of the company on a cash basis from 36 million to 70 million. That's why you look at both, okay? You can't just look at the income statement because this shows you the company is actually in reality bleeding almost twice as much cash, even if their income statement showed a profit. So that's that. That's freaking horrible. That's garbage. That's trash. That scares the crap out of me. Now, the next thing, net cash used in investing activities. That's basically to buy new crap for the company. So it went up. Well, they actually had a net inflow of cash in 2019, which is from proceeds from sale of fixed assets. So I don't know why they sold fixed assets in 2019. Maybe because they were so short on cash, they had to sell their fixed assets. But in 2020, they didn't sell any fixed assets, and they spent about $5.7 million on capital expenditures. So they sold assets in 2019. They sold assets in 2019, and they bought some in 2020. That's really cool. But net cash used in investing activities is negative $5.7 million in 2020, which isn't necessarily a bad thing. Now, very key here, ladies and gentlemen, net cash provided or used in financing activities. This shows you what cash the company is getting from selling stocks, which shows dilution, or issuing debt. Now, looking at this, there has been a massive increase in the net cash provided by financing activities. So in 2019, they raised $58 million of cash from financing activities. And then in 2020, almost $300 million from financing activities, which means they issued either a lot of debt or a lot of stunks. But they actually did both. Here's what they did. So you look, and we have a redemption from issuance of mandatory redeemable. Okay, so that's a cash outflow. Proceeds from issuance of convertible notes, $262 million. Now, a convertible note is basically a debt instrument that can be converted to common stock. So even though you may see the debt go up, and you're like, oh, they're not really diluting the shareholders, those bonds can be converted into common stock, which will still dilute the current shareholders if that conversion provision is exercised. So that's very worrying to me as an investor, which I'm not in this company. But if they issue $262 million of convertible notes, those could be converted into common stock and massively dilute you. And then on top of that, proceeds from exercise of options and warrants. So it looks like a lot of people exercise their options and warrants, which further dilutes the shareholders. Oh my God, this company is freaking garbage. Garbage. Woo! Jesus, do not invest in this freaking company. I don't care what Stunkmo said, the freaking idiot clown. This is horrible, okay? Please. If you want to speculate, keep it to a small percentage of your portfolio, 5% or less. Maybe the stock will go up. I don't know. But from a fundamental basis, this is complete and utter trash. Anyway, that's it for now, ladies and gentlemen. I hope I taught you something about how to look at financial statements. Please like the video, subscribe to my channel, buy my book, Stop Being a Broke Loser. It's on Amazon for $3 for the ebook or $10 for the hard copy. I know it's going to crush your finances. Y'all have a wonderful, delicious day.